to Start Here, the very special mini-series within SugarMamma's Fireplay, where I answer your real-life money questions with practical, empowering general advice. Today's question comes from a couple in their early 40s, and I have a feeling that a lot of other couples in similar situation will be wondering the same thing that these two are thinking about. They wrote, "Hi, Canna. We're 40 and 42 years old. We owe $148,000 on our home loan, have $20,000 in combined HECS debt, $93,000 in shares, $20,000 in emergency savings, and together we earn around $270,000 per annum. Our question to you, should we be focusing on paying off the mortgage or paying down our student debt or investing more into shares or perhaps contributing extra to our respective superannuation accounts?" All right, before I begin, I just want to be crystal clear. I cannot give you personal financial advice, particularly over a podcast episode. However, what I can do right now is walk you through the key considerations, the pros and the cons of each option that you're questioning right now, and share some valuable strategies that will help you think critically about your goals and the deadline of these goals. Because this isn't actually about picking the best option, but rather it's about finding a way to make all of these goals work together in balance, in harmony, and of course with efficiency in a way that makes sense to you and you can see and feel the progress so that you're inspired and empowered to keep going from the moment you get started. So let's go through absolutely everything that you need to be thinking about right now together. All right, step one, let's start with the foundation, the most important foundation being the safety net, emergency money. This couple has mentioned they have $20,000 in emergency savings. Now, that is a brilliant start. However, I want to encourage reviewing whether this is actually enough. Think about 3 realistic risks in your life. Perhaps a job loss, something happening to your house that is uninsurable, a health event, something that's again not covered by insurance, or an unexpected family expense, or even a car expense, and work out what the financial impact would be to you. Take 3 of these and look at what that total is. And that total can then give you perhaps a more personalized emergency buffer to work towards. Remember, this safety net isn't, a rainy day account. It's what protects you from undoing years of financial progress in your life. Without having emergency money, you run the risk of dipping into your investments, like having to sell them down, redrawing off your home loan, or even taking on high interest debt. So for now, obviously keep this emergency money in an offset account because that is typically the smartest way to help reduce mortgage interest, but was also obviously whilst having immediate access to this. But please review that number of $20,000 to see if it is right for you. Okay, let's look at the actual options now. So option 1, paying down the mortgage. Your home loan is what we call toxic non-deductible debt. It doesn't provide you with any tax deductions, it doesn't provide you with any passive income, and it drains your cash flow. Here's why it really matters. Over a traditional 30-year term, assuming no refinancing or no redrawing, the interest cost can be absolutely staggering, and no one really talks about this. So, for example, a $600,000 home loan at 6% will cost you almost $700,000 in interest alone over its life. And that's assuming no interest rate cuts or interest rates going up. That's more than the original loan amount. However, if you paid just an extra $200 per month from the very beginning of when you took that loan out, you could actually save around about $106,000 in interest and shave almost 4 years off the term of your loan. This is why I always say, extra repayments is a guaranteed return. So the upsides to paying off your home loan and making it a priority is obviously every repayment reduces the interest immediately and creates risk-free. It also obviously reduces the financial stress and creates an enormous peace of mind. Imagine not having a home loan. I mean, oh my God, that just feels liberating. And now, of course, once it's paid off, your monthly repayments that were obviously going towards a home loan are now completely freed up to direct into anything you want, whether it be, investing more aggressively, putting more money into superannuation, or even just perhaps improving your lifestyle, maybe more holidays. As you build equity also, you unlock more opportunities for strategies like debt recycling, which I'm going to come to in this episode because it's pretty important and it's definitely worth considering. There's obviously, two sides to every story and there are the cons. So the trade-offs for putting extra money onto your home loan and paying that off as a priority is liquidity. Money in the mortgage isn't necessarily easily accessible unless you have a redraw facility or an offset account. There's also the opportunity cost. Mortgages might be 6%, but you could potentially earn, more than that on investments, particularly if you're really good at picking stocks. And, even your superannuation is another opportunity cost here for you. If it's delivering returns of say, 8 to 9% per annum and you're paying 6%. There's also obviously the issue of, lack of diversification. By paying off your home, so much of your wealth is actually tied up into the value of your property. And this is actually a really big concern of mine, that so many Australians are so highly leveraged in property in that the home that they live in, they have no other choice but to pay off their home loan as quickly as they possibly can. So there is no money to put aside to diversify into super and to investing. However, not necessarily the case for you guys. So remember, reducing non-deductible debt always helps strengthen your position, but it is about balance, not extremes. Now, option 2, should you be paying off the HECS help debt? So HECS debt is a very different type of debt here. It's not necessarily interest bearing like a credit card is or a mortgage, but instead it is indexed to inflation once a year. So here's how it works. Every June, your balance is adjusted by the Consumer Price Index, the CPI. So in 2023, this actually spiked to 7.1%, which naturally made headlines. But fortunately, it's back down to, I think, 3.2%. Now, over time, it usually averages lower than most mortgage rates or investment returns. So repayments are income contingent, and the repayments obviously taken out, by your employer when you get paid, and they kick in when it's above the threshold, which is around about $51,000 a year. Now, the benefits in clearing this HECS debt is simplicity. One less thing to have to think about. I know a lot of people who've sent me a DM saying that they paid off their HECS debt and it felt, so it's like a huge weight off their shoulders. And it just cleared the path for them to work on exciting goals. There then, of course, is the emotional relief. You just might want to just get it done and get it paid off. And then there's the increase in your net pay because your employer is no longer taking out HECS repayments. And then, of course, it actually may increase your ability to borrow further down the track. A lot of people don't realize this, but your HECS debt is calculated in your serviceability when it comes to borrowing. It's not a huge impact, but it definitely goes down as other liabilities that you're carrying right now. And of course, it gives you a really clean slate if you ever want to go back to university or do some other sort of tertiary studies and you're needing to borrow again. You're not adding to that $20,000 worth of debt, you're starting afresh. And there's also, I guess, the ethical benefits. Our HECS help debt is only going to continue on working and help educate our future generations, which is essential for our country and for our economy, if we actually respect these debts and pay them off in a timely manner that we can obviously afford. Now, what is the flip side of this, the cons? So there's no redraw facility. Once you make extra payments to your HECS debt, you can't redraw it. It's gone towards that debt. Now, some people, I'd say that's a great temptation that's removed because it's stuck there. You have to stick to it. And obviously, the other downside is it's considered to be relatively cheap. I don't really like the word cheap, but maybe more cost-effective debt in comparison to mortgages or, credit cards. So whilst it's not necessarily a number one top financial priority, it still might feel good making an emotionally based decision to pay this off, whether it's strategic or not. Option number 3, investing more into shares. All right, so this couple has already mentioned that they have $93,000 in shares, which is a brilliant start. Now, assuming a dividend yield of 5% per annum, this could be generating a passive income stream of around about $4,650 per year in passive income. So that is money working for this couple without them having to physically lift a finger. And the more passive income that we have in our lives, the more financial freedom we have. That's the ultimate goal. So what are the benefits of investing more into shares? Well, obviously, you've got that long-term growth opportunities. On average, depending on which charts you look at and which data and obviously which asset class, but historically shares, return between 7 to 11% per annum over, a 20, 30, 40-year period. Also, you're earning passive income through the dividends, which, as a shareholder, you can decide whether you want to reinvest them or just take them as cash flow. And perhaps you can use this cash flow if you wanted to help pay off your mortgage, off sooner. So you aren't just relying on your income. You're also relying on the dividends that are coming in each year to help pay that mortgage off faster. You've then obviously got flexibility. Unlike superannuation, you can access the money within your share portfolio at any time before retirement. The government has no control over this, which can be very liberating. And of course, importantly, you're diversifying beyond the family home. Not all of your money is tied up in that one massive asset. You're tapping into 2-dimensional, 3-dimensional assets that provide income, capital growth opportunities, and growing passive income opportunities. So the downsides, we want to look at this accurately and evenly for both sides. So obviously, volatility. I don't know what your risk profile is. I'm going to assume it's a growth or high growth, but, and hopefully you're aware of this, but the share market can drop, 20 to 30%, in a pullback or a correction or a downturn. So if you're using shares as your wealth creation strategy, you need time and you need patience. And also you need a lot of sort of mental resilience, not getting caught up in the herd mentality and panicking and selling during downturns. There's also the tax. So yes, you're earning dividends, but you have to pay tax on those dividends. And if you do decide to sell, you've got to pay obviously capital gains tax as well. However, I will also mention, depending on what you've invested in, if it's Australian shares and they pay franking credits, that's obviously going to help reduce that annual tax burden on the income. Then, of course, there is the inefficiency. Now, this is really important, this one here. You are still carrying through your mortgage non-deductible debt. So if you were to go and sell these shares, and again, this is not advice, I'm just looking at different ideas for you to consider. But if you were to sell those shares today and pay off your home loan, you'd be knocking a good 66% off your home loan. But of course, you'd need to obviously account for, the capital gains tax being triggered and of course, brokerage costs. So you would not do this. You'd go and speak to your accountant and get a rough estimate as to how much capital gains tax would be triggered and whether that's, right for your long-term financial goals. But technically there is an inefficiency. You want to try and minimize your personal debt, maximize your investment debt. So to answer this question, yes, investing is incredibly powerful, but, does this particular strategy fit alongside your debt and your super goals? Perhaps not necessarily. And then, of course, there is option number 4, contributing to super. So for people in their 40s, superannuation is one of the most effective tools for building retirement wealth. And I will happily share with you, it is probably the second most important financial strategy that Tom and I implement in our own personal lives. And for the record, we also have a debt recycling strategy as well. But, for us, it makes a lot of sense to utilize this environment to help build wealth up. And these are the reasons why. It's tax effective. Concessional contributions, which is money going into superannuation, are taxed at 15%, which is often far lower than the average marginal tax rate that an Australian pays right now. Also, the income that is generated from the assets within super are also taxed at a maximum rate of 15%. And then capital gains tax also taxed at 15%, but sometimes that can be 10% if you've held that asset beyond 12 months. But with that tax rate on the income of 15%, that can actually sometimes be wiped out completely if you've got franking credits attached to Australian industrial shares in your assets within super. So there's some significant tax savings alone right there for utilizing super. And then because you don't have that eroding impact of tax, greater compounding growth opportunities, and you've got those contributions coming in through your employer, even small ones can really snowball significantly and really increase your superannuation account balance when you're ready to retire in your 60s. Also, when you are looking at contributing to super, there is a really great sense of peace of mind knowing that your retirement is secure. You're not going to be retiring in poverty. You're going to be retiring comfortably and on your own terms, and you're not going to be reliant on the government, hopefully. Now, the downsides. Okay, this is also really important to understand. Lockup. Once your funds are in that superannuation environment, you cannot access them until you meet preservation age. Now, here's the other, curveball. The rules can change. Yes, our governments, as we're seeing right now, are starting to tweak the superannuation laws, which naturally makes people feel nervous. And then, of course, you've got the issue with competing goals here. You may want to actually, and I don't know the finer details of your goals here, and you may not even have any particular goals, but you may actually want to retire before age 60, before you can actually access your superannuation money. So that's really important consideration that's got to be weighed up here. So yes, superannuation is also incredibly powerful, but it's not about maximizing it at the expense of losing out on everything else. It is one important piece of a big puzzle. So what are other strategies that I think you should be considering or getting personal advice on? Well, I mentioned at the beginning of this episode, and that is debt recycling. This is a more advanced approach, and it is essentially where you pay down your mortgage, but then redraw the funds and invest the funds that are made available through a separate investment loan, but into income-producing assets, such as buying more shares for your share portfolio. And over time, this can be really powerful. And as I said, it's a strategy that we use, Tom and I, ourselves. So as the mortgage is shrinking, the investment loans are growing. But the key difference here is that the investment loan interest is actually tax deductible, and that money is being used to produce passive income. It is a way of building wealth over the long run, but also whilst allowing you the space to continue on working on paying off your mortgage as quickly as possible. It is definitely a more complicated and a higher risk strategy, and it absolutely requires really careful advice from an experienced mortgage broker who needs to set this up for you correctly, the right way the first time, but also a financial planner who has a lot of experience in managing this type of strategy and knows exactly how to educate you around navigating these risks in a proactive manner that makes it really safe and secure for you to the best of your ability. And in my book, Mindful Money, which I highly recommend, I actually share, I think, about 7 different ideas to help you use this strategy in a almost bulletproof way. So you're going to have to be really clear about understanding this, the risks, but also the benefits. And you also need to be really clear with your HECS debt, or actually both of you, look at maybe boosting those emergency money before you even consider doing this. So you may see a financial planner and they may say, yep, that's a great idea. Canada's on the money here. But before you begin, let's pay off that HECS debt and let's boost up that emergency money. If you're hearing that sort of advice from a financial planner, I'd say you're in safer hands. Now, for the right household and you're at the right stage of life, a debt recycling strategy can be seriously a game changer. But for others, it's not right. It doesn't sit with their risk appetite, it doesn't work with their timeframes, and it doesn't work emotionally. It's just unnecessary stress in their life. And there are people who it's not right for. So this is why you need to make sure you're getting advice that guides you, but also educates you at all times. So what is the answer here? Well, there isn't just one. The real answer is you don't have to actually choose one strategy here. It's not a matter of should we do this or that or that or that. It's actually something more bigger than that and better than that. It's about finding a strategy that blends all of these goals at the same time. Doing a little bit of everything in an efficient way. Paying extra onto the mortgage, making superannuation contributions, perhaps, some salary sacrificing, investing consistently, whether it be through a debt recycling strategy or setting up a regular investment plan or even a gearing regular investment plan, which is another option that's potentially available for you. And of course, eventually clearing that HECS debt. But it's about doing it in a way that is incredibly efficient, but most importantly, sustainable for your lifestyle and in alignment to your goals and your risk profile. So here are the next steps that I strongly recommend you follow, because you're in this really great sweet spot where you could really change your financial life if you get some great advice. So number one, get really clear about your goals. You haven't actually shared with me what your goals are, whether you want to retire at a certain age, how much income, what your risk profile is. So get clear. Understand what is important to you, what are the biggest priorities. And, if you don't know, look at what excites you. Is it freedom from debt? Is it the idea of an early retirement? Or is it about, the comfort and peace of mind, seeing lots of savings in your bank account? Money loves clarity and definition. Next is get a financial planner. And get a financial planner to run some numbers with you. When you see a financial planner, they will look at not just one strategy, recommend that. They will show you how they have compared a couple of different strategies, and they will show you the numbers where they've looked at, for example, prioritizing paying off your mortgage and, a regular ongoing gearing strategy, or they've looked at a strategy where it involves paying off your mortgage, but also looking at an aggressive, salary sacrificing or superannuation strategy. They will show you the numbers and they will show you the projections. So you can then compare these and you can then make really great, wise, sensible decisions that are right for you. The other thing I would recommend whilst you're searching for a financial planner, and if you want to send me a DM asking for some recommendations, please don't hesitate. I have a couple of financial planners that I'm happy to recommend, and there's no incentive for me whatsoever. But, whilst you're interviewing financial planners, I recommend, again, coming back to that emergency money number and looking at, is $20,000 enough, or do you honestly need to maybe look at increasing it in the meantime whilst you're shopping around? And then you haven't mentioned this, but I don't know if you have this in place or not, but I want to make sure that you're aware of it, because I think it would be negligent of me not to mention this, but protecting your lifestyle. I'm talking about personal insurance. Do you have income protection? Do you have trauma cover? How much life and TPD cover have you both got? You really want to protect your financial situation so that if something happens in the blink of an eye, which things do happen in the blink of an eye, we all know that, your hard work so far to date is never undone, is never jeopardized, is never, back to square one again, starting from scratch. This is really important to not just this couple, but for everybody listening. And again, I can't stress enough the importance of seeking professional personal advice. Not a finfluencer, not going by this particular podcast episode or one of my podcast episodes. Seeing a financial planner, having a private appointment with them and getting them to do a statement of advice where they can model these different strategies for you, compare them side by side, and you can see what opportunities lie ahead for you in your future, and you can start to act and get started now. So this is a lot of pleasure doing this particular episode, as it is for all of them, but this one, I just am excited about your future because I can see there's so much potential for you if you can get advice and get cracking. You've got a really high income. You've got a really manageable home loan. You've already made a fantastic start with your share portfolio. You're already in a position of financial strength. And it's not about sacrificing one goal for the other here, which I hope you now see. It's about aligning all of them so that you can move forward on every single front of your life. So thank you so much to this listener for sending in this very thoughtful question. And I know it's a question that a lot of other people have, will really resonate with. And as so many of my listeners are in their 30s and 40s and beyond. And in the meantime, for everybody else who listened to this episode and found it helpful, can you please do me 2 huge favors? I would be incredibly grateful. The first thing being send this episode to a friend or a loved one that might be wondering the same questions right now. And then, of course, can you please take a moment to leave me a rating and review? Every single rating and review really means a lot to me because it means that I am helping you, I am of value, I am of service to you, and you get to listen to this for free. And a lot of these things I make in my own free spare time. And in the meantime, if you have a question yourself that you are dying to ask me and you'd like me to put it forward for our Start Here mini-series within Sugar Mama's Fireplay, please make sure you send me a DM on Instagram at SugarMammaTV or Canna Campbell Official. I'll even leave my email address in the podcast notes, as well as an important episode about how to find the best financial planner for you. All right, everyone, thank you so much for listening to today's episode. I will catch you next Monday morning on Sugar Mama's Fireplay. Thank you for listening and have a fantastic weekend. Ciao for now.